What is going on, guys? Welcome back to the Young Financials channel. So yesterday I talked a little bit about vertical spreads and iron condors. I didn't really get into iron condors too much as vertical spreads, and I kind of just want to go over vertical spreads again and clarify exactly like how you should be doing them. Now, just because I do them a certain way and just because the way that I do them works for me does not necessarily mean that it's going to work for you. So you have to figure out yourself if it's going to work for you. You have to pick out a strategy. Vertical spreads that I've noticed so far have worked for me. However, that's just how I go by them. So what I do with them is I will take a stock like Facebook, for example. Now I just have a call in Facebook. It's a $210 call set for I think it was next June or July, something like that, in 2019. So what I like to do is find small or places where it's down. Okay, so Facebook's down, I mean, a fair amount. It's down 15, almost 16% in the last 3 months. And the reason it's down is because of this point right here where their earnings just came out. And honestly, I think personally that this is an over-exaggeration. I think the stock did not need to drop that much. Like, it's down for the year. Yeah, it's down $5 for the year, 3% now for the year. So, in my opinion, I think that's a huge overreaction. Facebook is a growth stock. Instagram has tons of potential still, and not along with, or that's not even talking about their other stuff that they have. Like, they have so much stuff on the back burner that they could do for revenue, and people just saying that, oh, it's going to slow down a little bit or it took a big hit. Like, I think it's just an over exaggeration. We'll see in the next coming years. Personally, in my opinion, I think Facebook is going to be really good for the next coming years. It is a growth stock now. It's more of a value stock now, I guess you could say, but in my opinion, I think people really need to put it back into the growth stock category because, I mean, honestly, there's so much potential that Facebook has. So, along with vertical spreads. So, here's how I do vertical spreads. So, I look at the last 3 months typically, and I bought the Apple about right here. So, it was trending down. You can see it was trending down. And what you want to do is, typically what I'll do is, I talked yesterday about using 75% into an ETF or the S&P 500 tracker, and then the rest of the 25% into calls and spreads. So what I do is I actually bought one when it was right here. I bought 2 vertical spreads for Apple when it was right here. And then I bought a little bit more when it was right here. It did actually go down. There was a low. I forget exactly where it was. I did pretty much buy it at the low point. So then you can see that this was the peak. You don't want to buy a spread at the peak for a month out. Obviously, you want to buy low, sell high. So what you want to do is I bought here, and this is kind of where, now, Apple could have kept falling a little bit. If you look at the 1 year or even the 5 year, it does have a pretty drastic up, so you would think that it would drop a little bit more. But, I mean, the past does not always go off of what the future is going to hold for a stock. So that's technically not always true. Most people think, oh, wow, it's going to go up. It's going to either keep going up or it's going to keep going down because it's been going down. That's not really always true. But for this case, you see in most stocks, you look at the 5 year, it has downs and then it has ups and then it goes down and then it goes up and then it goes down. But it's mostly trending up for the most part. So what you want to do, I thought about that and I was like, okay, well, if you want to buy at a low, instead of buying the raw stock, maybe you just call a vertical spread. And I was thinking this, and I was trying to think in my head, like, there's got to be some catch, because in my mind, if you have, let's just say you look at the 1 month or the 3 month for Apple, it's up $42, 23%. You look at the 1 month, it's up just 1%, 1.2%, not a huge deal, but that's buying kind of at a high. If you look here, you bought at August 30th, so you're back here, you're buying at a high. You're buying at its all-time high before August 30th, or at August 30th. So this hasn't really gone into effect yet, but August 30th, it is the all-time high for that stock. So that's obviously not smart to buy it there because you know there could be a pullback. So what you have to take into account is the fact that when it goes up like this, it's going to pull back. And when you pull back, you want to load up. So my thought process was that, okay, what I'm going to do is I'm going to try to just place a vertical spread, because I know vertical spreads depreciate, but they depreciate so small you're really not going to notice it. Because if you have a long call out or a long vertical spread out that maybe expires 45 days, maybe 60 days, almost 2 to 3 months from now, you can know that it's not, even a call doesn't really expire that much. So a vertical spread's definitely not going to, because it's just based off of where the price is at. Now, if you let it expire, I personally don't think I'm ever going to let it expire. I think I'll sell it before the expiration date, just because what my thought process was is that you buy low and then you let the stock most of the time, except for exception of right here, within a 6-month span, if you buy it, except for right here, that area in 2015 to 2000, pretty much all of 2016, the stock went down. But for the most part, in a 6-month period, no matter what 6-month period you pick, except for that, the stock has gone up. So my thought process was that, okay, I'll buy it at a low point or a lower point, and then I'll wait maybe like 2, 3, 4, 5, 6 months or whatever. I think it's January 18th is it, so it's like 4 months out. So I was like, all right, I'll just wait, and then once it goes up maybe a decent amount, I'll cash out, and then I'll just keep doing the same thing every time it goes down. So like right here, if you would have bought in here and you would have just waited, and then you would have cashed out, maybe I probably would have cashed out. Actually, I honestly probably would have cashed out right here. But if I would have waited, you could have cashed out maybe right here, at the top, and then you bought in low, and then bought in low here, and then bought in low there, and then it's the same thing. Now, obviously, nothing's ever perfect in the stock market. You can never be 100% right all the time. It's not possible. I don't even think you can be 75% right all the time. Well, you can in certain scenarios, but you can never, you're always going to, in the long run, you are always going to be 50% right when you're guessing the directional move of a stock in the short term. Now, in the long term, it's a little bit easier, because obviously you don't know 100%, but you could definitely say that, not definitely say, but you could have very good confidence that Apple is going to be above their all-time high. It's just, it's obviously you won't know until it actually happens, but you can pretty much say with confidence, I can pretty much say with confidence that Apple is going to break its all-time high. That's just how it works. Stocks naturally move up. That's how everything's supposed to work. So if you look here, Apple only gained 0.35% here, right? And my call, this is my call in the let me go into my call actually. And the call gained 2.2. So it's a very easy way to make money. So if you would have bought in yesterday at Apple, the open for the call or the vertical spread would have been $9. So we know that you have to have, that's for one contract. So you know that one contract equals 100 shares. So you have to multiply that. That is $9 per share. I'm sorry, not per contract. So each contract is actually $900, because you have to buy 100 shares at $9 for a one contract buy. So you're buying $900 worth of it. Now each one would be worth $920. So basically you gained $200, or no, not $200, $20 per contract you have. So that's kind of how it works. Now I have 8 contracts. I know back here it said I had, if you go into the actual Apple and you go down here, it says I have 16 contracts. That's just because I technically do own 16 contracts, but I own 6 buy contracts and 6 sell. So that's, the 6 sell are actually losing me money. So if you look here at the ones I have buy, those have made me $136 for the day. Total of $2,550 on my return. But if you look at the sells, they made me $24 today and lost me $1,165, because I'm betting on it to go down with these contracts. Basically, like, these contracts are me. I lose money every time the call goes up. So if you look for the all-time, it was worth this, and then it goes up, or that's the 240 call. So it's losing me money over the long run. Now, if you look at the call all for the vertical spread, it's pretty much the same thing. It just combines both the buy and the sell at the same time. So then you get your 920 at the very end. So that's kind of just how they work. And I don't necessarily advise doing this with a lot of money at the very beginning. Maybe just buy one contract at first. Maybe buy one contract. Just try to get into the feel of how it works. Like what I'm doing with Iron Condors on my other account, which I will go over. I just bought one because I have no idea how they work. I mean, it's very complex to me. It's very volatile in my opinion, and it honestly is kind of boring. Vertical spreads and calls in general, a little bit more entertaining, I guess, because you see a stock going up and you're like, oh wow, I'm making a lot of money off my spread or my call. And that's kind of how it works. And that it's more exhilarating, I guess. It gives you more of a rush. And I mean, you can't sit here and tell me that you don't enjoy a rush when you comes to the stock market. Otherwise, you wouldn't be in the stock market or day trading or swing trading or doing whatever. You can't tell me that that's not true. So hopefully we'll see next week how this does, and hopefully it'll give me a little bit better of an average, because I know I am not averaging $2,000 a day or $2,000 a week. There's just absolutely no way that's possible. If I wish, that would be probably, I could quit my job right now, but no. So we'll see. I'm guessing probably along the next couple of weeks it'll probably average down to $250, maybe $300. I don't even know if it'll go that much, but we'll see how it goes. So yeah guys, so if you guys like this video, give it a like. If you're new to the channel, give it a subscribe and hit that bell button for notifications. All right guys, thank you very much.